All right, welcome to the run through of our quantitative systems. This is just going to basically go through our tools, our process, how we position based on different market and economic regimes, how to, how to implement these tools into various strategies like long only strategies, long short strategies, and then, yeah, just an general understanding of how all of the what all the tools do individually, and then how they all sort of fit together. All right, getting into just the general overview of our process. I've been in this game for about 7 years, 8 years, and the one thing that I noticed myself and of every investors in general is that the hardest thing to do in financial markets is to manage risk and to do it like very well. And a lot of investment professionals, a lot of financial, a lot of investors, a lot of financial professionals, they just don't, and even retail investors, they mostly retail investors, they just don't really know how to manage risk based on an actual like process. It's very much based on, oh, like I read this piece of research and I'm gonna change my positioning, or I have like this feeling about what is gonna happen in the market, or the I have some obscure projection or forecast of what might happen in a year, or somebody told me that the market's going to crash, and then they try and position based on just these feelings, whims, one piece of research they read, and it's just not that effective. So we built out our entire systematic process to help us manage risk and position based on what the market is actually, just based on observing what the market is telling us and what the data is telling us, instead of just trying to guess or or uh, like project or forecast what is going to happen in the future, and then try and make decisions based on that, is which sometimes you can be right and sometimes you can make a lot of money doing that. But in general, it's not the most effective way to consistently manage risk and generate returns over a long period of time. Getting into our first system, this is our probably like our bread and butter model. We use this the most, and we even incorporate this into some of our other models, like our market regime model. This is our quantitative positioning signals. And so this model very basically just uses, um, it's a statistical model that scores volatility and momentum in an asset in order to identify breakouts and breakdowns in an asset's trend. And this helps us manage risk and uh, dynamically position based on the probabilities of where an asset is going to be going next. In this slide, you can see the signals plotted on Bitcoin and Ethereum. You'll notice that it generates bullish, bearish, and neutral signals. So red, very simply on the chart, is bearish trend. Yellow, very simply, is neutral trend, or there's like price is kind of in a either like a very high volatility state, or like a very like sort of whipsawing, or there's a low probability of where the trend is going next. And then obviously green is bullish trend, so the asset is trending higher, or um, yeah. And then one last thing is that neutral trend also, it can be like a transition. So you're transitioning from a bullish to a bearish trend, or a bearish to a bullish trend. And neutral will sometimes, depending on the speed of that transition, neutral will sometimes, the signal will transition to neutral and then back to bullish, or bullish to neutral to bearish. Here are the signals plotted on the S&P 500, TLT, which is bonds, US dollar strength index DXY, and then also plotted on gold. And this system across asset classes, it has a very high upside capture ratio, which means that we've back tested this these systems across over 50 different assets, and it either performs about the same if you just follow the signals, or it actually outperforms. So like for Bitcoin, if you just follow the signals, then the we would actually be able to trade Bitcoin better than Bitcoin can trade itself. So we would actually perform better than just owning, buying, and holding Bitcoin. And we would also, obviously, the key idea is, to have much better risk management. So we're managing our downside risk and either capturing and then also capturing the vast majority of the upside, if not more upside. Getting into our economic regime model, this model pretty much tracks the rate of change in growth and inflation on a 3-month basis. So 3-month rate of change in growth and inflation. And then this model pretty much helps us track which regime we're in, right? So there's 4 different quadrants to the model. There's, rising growth, rising inflation, declining growth, rising inflation, rising growth, declining inflation, rising growth, rising inflation, and then there's declining growth with rising inflation, and then declining growth with declining inflation. So those are like the 4 different quadrants, those 4 different combinations of growth and inflation where they're trending, and then this helps us really understand where where is the economic data going, not just where it is. And it's a much better gauge of what is going to be happening, what's happening in the economy. Most people look at levels of growth and inflation, but what markets really care about is the rates of change. And so this helps us track the rates of change so that we can understand what economic regimes we're in. So right here you can see the actual model with the quadrants, and you can see that the dates on here basically show where growth and inflation are for that particular month. So this tracks growth and inflation on a month-to-month basis. Just the data that we input to the model is month-by-month data. And so you can see, like, for example, we started in January 2024, we started with growth and inflation. We were in a declining inflation, rising growth regime. And then we kind of moved a little bit into rising growth, rising inflation, and then we moved back deeper where we had kind of declining growth with declining inflation at the same time. We almost got into declining growth and declining inflation, like a deflationary regime. And then over the last 4 months roughly, we've moved back into rising growth, rising inflation regime. In this chart, you can see this is the regimes plotted on the S&P 500 going back to 1990. So you can pretty much see, like, these are what the regimes have been at different points in time. So, like, for example, you can see during the 2008 financial crisis, we were in a deflationary regime. We pretty much, like, using this model, we would have completely sidestepped that drawdown, because we would have known, all right, like, the declining growth regimes are generally going to be risk off. So we would have been out of the market during 2000, like pretty much all of 2000, and then all of the 2008. And then again in 2022, we were in a inflationary risk off regime, declining growth. And then we moved into a deflationary regime, and then back to a risk on with falling inflation regime. And this just gives us an idea. It kind of just shows us how this model has, like how the economic regimes have sort of developed over time. So this now we'll be getting into our market regime model, and this model uses our positioning signals with, like, in combination with our economic regime model. And what it does is we've input a bunch of different asset classes. So like stocks, bonds, commodities, currencies, crypto, volatility indices like the VIX or the MOVE index, which is bond volatility, or currency volatility, and then we basically backtest all those, the model backtests all those different assets across the regimes across time, and then we understand how how all these different assets behave um, across the different economic regimes, and then we can use that information in order to score each economic regime um, based on asset performance to understand what asset markets are trying to price in. So an example would be that, like for example, stocks perform well in a risk-on regime. So like in a rising growth regimes, stocks perform well. So if the S&P 500 or the Nasdaq have a bullish positioning signal, then they will get then like the both of the risk-on regimes will get 1 point. Or if they have a bearish signal, then the risk-off regimes will get 1 point. And if bonds are, for example, like bonds are typically in an inflationary environment, a lot of times interest rates are rising. So a lot of times if bonds have a bearish signal, then that means we're in an inflationary regime. And so, in inflation, like both of the inflationary regimes will get a point. And so that's like a general overview of how this model works. And then we also have incorporated like a probabilities model into this model to help us understand like what not just like what are asset markets pricing in, but what is the highest probable regime that we're in, especially, which is important, especially when we're in sort of like hybrid regimes where like all of the each regime has a very similar score, and it's kind of hard to understand, all right, like what regime is the highest do we have the highest probability of being in. And so that probabilities model helps us kind of find a little bit of clarity in that. All right, so in this chart we've got the dominant market regime on the right side, and then we have the sum of market regimes on the left side. So pretty simply, when the sum of market regimes can almost be looked at as like the strength of the signal. So when the sum of market regimes is higher, then that means there's higher conviction in the market regime. And when the sum of market regimes is lower, then that means there's a little bit lower conviction, and like we're kind of in a transition phase, or we're in just like a phase where a lot of the signals might be neutral, like a lot of positioning signals for many different assets might be neutral, and so we're just not a lot of like there's not a lot of clarity. The market doesn't really know what it wants to price in yet, right? It's kind of just like in a transition phase. And then we sometimes can call this like a hybrid market regime. Dominant market regime is that obviously, pretty straightforward. That just shows which regime is the most dominant. So like right now we can see that risk on disinflation is the dominant regime. So yeah, that's pretty yeah, dominant market regime, that part's relatively straightforward. Here, these charts pretty much just plot the different market regimes across time, across both bonds and the S&P 500, and you can see that the regimes look relatively similar to the economic regimes, because you can, I mean, it's pretty obvious that obviously, the way that we've constructed this model, is based on the economic regime model, and so I mean, but you can pretty much just see it's similar, but it's much more proactive. So this model does a much better job at switching between different regimes more quickly, because it's actually tracking what global asset prices are doing, right? Are Japanese stocks, have a bullish signal? Do they have a bearish signal? European stocks have a bullish or bearish signal? Um, does Bitcoin have a bullish or bearish signal? Does like the trading pair between the Japanese yen and the US dollar have a bullish or bearish signal? So it tracks all these different asset classes to help us understand what asset markets are trying to price in, and which obviously makes it much more dynamic, and it switches. And then obviously, um, occasionally that means you get little false signals here and there, but for the most part, it's very accurate, and it captures it captures most of it captures pretty much all the upside in the S&P 500 while managing drawdowns, and it also does the same for Bitcoin. It actually outperforms Bitcoin. So if we were to trade this, we were to use the market regime model to trade Bitcoin and just trade Bitcoin based on the regimes, then we would actually capture more upside than if we were to just buy and hold Bitcoin. And then obviously, just like the positioning signals, we would manage our drawdowns, so we have much better risk-adjusted returns. The next model is sort of a derivative of our market regime model. So what this does is it tracks the risk on and the risk off regimes, so we can understand like total what is like the total breadth of risk on and risk off assets, and then it helps us identify extreme levels. So have markets like overly priced in a risk off environment, like for example in the bottom of 2008, or are asset markets way overextended, and like all of the risk off assets have bear signals and all the risk on assets have bullish signals, and that means that we're in an environment that is like you're almost like reaching peak, uh, like a peak level where asset markets have completely priced in a risk on environment, and they're sort of complacent, and that's sort of that can be a level where you don't want to be taking risk, or maybe even want to be selling some and moving assets either to cash or to like more risk off assets. So here you can actually see the market risk monitor. And yeah, again, like I said before, you can pretty much see like below the green, when the line crosses below the green, below that green threshold, you can see, generally that's a decent time to be, uh, taking a little bit more risk. And then when it's at extreme levels, then sometimes that can be a sign to be taking a little bit less risk. And you don't necessarily have to buy and sell. Like we don't really buy and sell purely based on this model, but it's just a really good gauge of like how much risk do we want to be taking, right? If we're at peak risk on level, then maybe we don't want to be adding a lot right now. Maybe we're at a point where we're going to get a little bit of a pullback in risk assets, and then that's a better time to start adding to positions. So this is our crypto market strength index, and it pretty much just tracks the positioning signals across the top 50 assets in crypto. And this model pretty much just helps us gauge market strength and weakness from the middle out, and then stay on it. It also is a really good gauge of short-term swings in momentum across the crypto market. So here on the right chart, we've got the actual market strength index with the 15-day moving average, and then on the left side, we've basically used the above 80 threshold and below 20 threshold, as well as the 15-day moving average, in order to generate bullish and bearish signals. So the green, when the chart is green, then that means the index is either above the 15-day moving average or it's above the threshold of 80. And when the signal is red, then that means it's either below the threshold of 20 or it's below the 15-day moving average. And then this helps us just basically track, actually get signals and track short-term swings in the momentum across the crypto market. And it pretty much again, it helps us manage risk. So we can see when the market is in overly risk on or risk off levels. And then based on, what the macro environment is, then we can kind of understand like, all right, here's a good time to start taking some risk. And then it also helps us understand, all right, like if we're in if we're in like a pretty bullish macro environment and, the market strength index is like extremely bearish levels and we start to get a transition back to bullish, then it's a good time to start taking a little bit more risk. And same, in the other direction, if if we're at extremely overextended levels, like pretty much at 100, where everything is bullish, then it's a pretty good sign, that when we start to see momentum deteriorate a little bit and it starts to roll over, then it's a good sign to start maybe taking some profits. Okay, so this is our how we actually use these tools. So this is a general guide. These are general guidelines or rules for how we actually position based on the signals. And so slide 1, we're going to go through the positioning signals. We pretty much just use these signals to position within the context of the market regimes. So if we're in a bullish market regime for a particular asset, then if we have a bullish signal for that asset, then we're max long position. So whatever percentage of your portfolio, like whatever the max allocation to that asset is in your portfolio, then you want to be maxed out in your allocation. So like let's say Bitcoin is 10% of your portfolio and we're in a bullish regime and it's got a bullish signal, then we want to be maxed out 10% allocated to Bitcoin. And then a neutral signal is a half position, and then a bearish signal is no position. And then again, in a bearish regime, then a signal, bullish signal equals no position, or a long, if we're in a long only strategy, then a bullish signal in a bearish regime is a half long position, and then a neutral signal is a half short position if we're in a bearish regime, and then for a long only strategy, it's a quarter to a half long position. And then if we're in a bearish signal, then we're either a max short position in that asset, or or if we're in a long only strategy, then we just no position at all. Here, this helps us position based on, this is the guidelines for positioning based on the market regimes. So a risk on inflation regime, we want to be max long position in stocks, crypto, commodities. Half long position, there's no half long position for risk on inflation. And then no position for fixed income. So we do not want to be long fixed income in a risk on inflationary regime, or really any inflationary regime for that matter. Risk on disinflation, we want to be max long position in stocks, crypto, and fixed income. And then no half long positions. And then we want to be no position in commodities, because commodities obviously are going down typically in a disinflationary environment. Risk off stagflation, again, max long position in commodities, but we're in a risk off regime, so we're half long position in stocks and crypto, and then no position in fixed income. So like bonds or treasuries, whatever. We don't want to be long those in a stagflationary environment. Like the worst environment for fixed income, like bonds, is a risk off inflationary, like stagflationary environment, right? Where inflation is higher and you have growth declining. That's like a terrible environment for bonds. Like in most recently in 2022, like treasury bonds actually performed, so 20-year plus treasury bonds performed worse than stocks performed. So the stock market was down 25%, the S&P 500 was, and treasury bonds were down over like around 50%, right? So that just shows like when you're in an inflationary environment and uh, interest rates are aggressively repricing to the upside, then you do not want to be long bonds in that environment. That's a great way to get. Uh, it's a great way to lose a lot of money. Okay, so this one we're going to go through how to position for the market regimes if you want to be running a long short strategy. So if you are someone who likes to short assets, then we can use we can basically use these rules in order to understand what assets do we want to be long and what assets do we want to be short based on the regime that we're in. So risk on inflation, long stocks, crypto, commodities, short fixed income. Risk on disinflation, long stocks, crypto, and fixed income, but short commodities. Risk off stagflation, we want to be long commodities, and then short stocks, crypto, fixed income. And then risk off deflation, we're long fixed income, and then we're short stocks, crypto, and commodities. Getting into our portfolio back tests. So to illustrate the effectiveness of this process, we've constructed a couple back tests of higher risk growth portfolio managed by our systematic process, and then we compared it to a benchmark asset allocation, and then we've also compared it to the S&P 500. The systematic process uses our market regime tool along with our positioning signals, and pretty much this portfolio backtest is pretty much follows the long only rules for the market regime, and then it also it follows the the positioning signal rules at all as well. The goal is to take advantage of like the main goal here is that we want to be able to take advantage of higher risk, higher growth assets, and capture a lot of that upside, but still systematically manage our risk from both the top down and the bottom up, right? So we're managing our risk with our positioning signals as well as managing our risk based on what the market regime is, whatever the market regime is, right? So what is the macro doing, and how can we manage risk based on like macro factors, and then what is the asset into each individual asset that we hold. What is the trend of that asset, and then we can manage risk based on the individual asset that we're holding. And the idea is that this helps us systematically manage our positions and not buy and sell based on just trying to guess what's going to happen in the future. And it helps us manage risk while still capturing the vast majority of the upside of that portfolio, if not even more. So getting into the statistics, so this allocation, this is 60% Nasdaq, which is like the tech index. We've got 30% gold and 20% Bitcoin. So this is a relatively higher risk portfolio. If you were to just buy and hold this portfolio, your maximum drawdown would be in the 30 to 35%. And then so we're comparing it to a benchmark portfolio of the S&P 500 60%, gold 20%, and then treasury bonds 20%. And then the green line is also that's just the S&P 500. So you can see, getting into the Sharpe ratio, you can see that the S&P 500 has a 0.78 Sharpe ratio in this back test. The benchmark portfolio has an 0.89 Sharpe ratio, and then our portfolio has a 1.56 or 1.59 Sharpe ratio. So we have a significantly better risk-adjusted returns by systematically managing our positions using a systematic process, as opposed to either just buying and holding, where we're going to have a lot more volatility, or trying to manage our positions just based on reading some, obscure piece of research and thinking like, oh, it's time to buy, or oh, it's time to sell. And that's just not a good way to manage risk and consistently generate returns over a long period of time. And then you can also see we've got compounded annual growth rate of 16%, or sorry, 18%, and then we have where the benchmark portfolio has a 10 compounded annual growth rate of 10%, and S&P 500 has a compounded annual growth rate of 14%. And then again, we also have a significantly lower maximum drawdown. So the S&P 500 has a maximum drawdown of 33%. The benchmark portfolio has a maximum drawdown of 22%, and our systematic portfolio only has a maximum drawdown of less than 11%. So significantly lower volatility, significantly less drawdowns, and and because we have a higher risk asset allocation, we're outperforming. So we have we're getting much more upside. So we have a much higher compounded annual growth rate with a much lower volatility and much lower drawdowns. Okay, so in this portfolio backtest, everything is pretty much exactly the same, but what we've done is, in order to capture even more upside, we've swapped out the NASDAQ allocation with a 2x leveraged ETF of the NASDAQ. So this ETF does double whatever the NASDAQ does on a day-to-day basis. So if the NASDAQ is down 2% in a day, then this will be down 4% in a day. And if the NASDAQ is up 1% in a day, then this will be up 2% in a day. So it just pretty much tracks the NASDAQ, but it does double whatever the NASDAQ does on a day-to-day basis. And if you were to just buy and hold this, like, you would have just barely crossed all-time highs recently. Just because of the way these leveraged products work. They bleed out when you're in a bearish market. So if the NASDAQ is like pretty much flat, then this is going to be down, like, significantly more. Just because of like the way the leverage works, and then also just like fees and stuff. But because we're trading the asset based on the market regime and then also our trend following positioning signals system, we're still capturing a lot of the upside, and then we're managing our downside risk. So this portfolio actually has a 25% compounded annual growth rate. And then obviously we have a little bit more of a maximum drawdown. So we have a 16% maximum drawdown, but our maximum drawdown is still significantly better than the S&P 500 and the benchmark portfolio. And we're dramatically outperforming. So because we're managing our risk and managing our drawdowns, we're compounding returns at a much higher rate. Okay, so this is our systematic ultra portfolio backtest, and this is even more complex, and it's also even higher risk. And so that's why we just named it ultra. So this pretty much, the goal of this portfolio is to achieve an extremely high growth rate while using our systematic process to manage risk. And the strategy includes a 3x leveraged NASDAQ ETF. So the last one we used 2x leverage. This is 3x, so even more extreme. 2x leveraged bond ETF, 2x leveraged short bond ETF, a gold ETF, a commodities ETF, and also Bitcoin. And so the strategy adjusts the target weighting of these exposures according to whatever the market regime is, and similar to like the rules that we highlighted earlier, it adjusts based on what assets perform best in which regimes. So we adjust the target allocation based on the regime, and then we also use our positioning signals again to manage those positions individually. So the target exposures for each regime are: in a risk-on disinflation regime, our target exposure is 50% TQQQ, which is the 3x NASDAQ, 30% gold, and 20% Bitcoin. A risk-on inflation regime, our target exposure is 50% TQQQ, 20% gold, 20% commodities, and then 10% Bitcoin. And then in a risk-off deflation regime, our target exposure is only 15% TQQ, 20% gold, 20% Bitcoin, and then we're 45% UBT, which is long, 2x long bonds. So, or treasury bonds, right? So like this is basically 2x long TLT, which is 20 plus year treasury bonds. And then risk off stagflation, we're again also again 15% TQQQ, 25% gold, and then 25% commodities, and then we're actually 15% TTT is short treasuries. So in a stagflationary regime, treasuries perform terribly, or bonds in general perform terribly, because again, like we highlighted before, in an inflationary regime, and especially an inflationary, negative growth regime, interest rates are typically aggressively repricing to the upside. So, and when interest rates are rising, then that means bonds are falling, right? So we want to take advantage of that by being short treasuries. And then again, we're also 20% Bitcoin. So getting into the next slide with the backtest and statistics. So the benchmark portfolio and then the S&P 500, those are the same. 60%, benchmark allocation is 60%, S&P 20% gold, 20% treasuries. And then this, so just to clarify, the target allocation listed here is over 100% because that is the maximum target exposure for each asset. But and then, like we highlighted in the last slide, that target exposure is going to change based on whatever the market regime is. So, so we're dynamically adjusting our positioning based on the market regime. That way we can manage risk, and also we're trying to capture the upside of whatever asset has the highest probability of generating the most returns in each regime. And so, getting into the Sharpe ratio, we have a 1.3 Sharpe, and then compound annual growth rate, we have a 30% compounded annual growth rate. So, number one, because we're using leverage, and number two, because we're aggressively repositioning our portfolio based on whatever the regime is and whatever the highest probability assets are of generating returns within each regime. So we're aggressive with leverage, and we're also aggressive with our positioning. And so that enables us to generate extremely high returns. Like a 30% compound annual growth rate is an incredible compound annual growth rate. And then again, because we're managing our risk, our maximum drawdown is only 20%. So we're taking a substantially more risk with the assets in our portfolio and how aggressively we're managing them, but we're still able to achieve a lower maximum drawdown than the S&P 500, and also, about the same maximum drawdown as the lower risk benchmark portfolio. So here we'll get into the systematic crypto portfolio backtest, and this basically illustrates the effectiveness of this process across just the crypto market. So this portfolio it's literally just crypto, and we manage it. What we're doing here is that the idea is that Bitcoin is technically the risk off asset for crypto. So, the Bitcoin outperforms everything else when we're in a risk off environment, even though it's probably going down as well. But the idea here is that this is if we wanted to just have a completely long, an always long crypto exposure. So we don't really there's no cash allocation in this portfolio. So we're 100% of the time either in crypto, but what we're doing is we're dynamically positioning based on the regime. So we own more Bitcoin. This portfolio owns more Bitcoin in a risk off regime, and it owns more altcoins in a risk-on regime. So we're taking more risk in a risk-on regime and taking less risk by owning just Bitcoin in a risk-off regime. So we're dynamically positioning for the regime. And then next, we are, again, using our positioning signals to manage each individual asset. So here you can see the systematic portfolio. The target asset allocation is 40% Bitcoin in a risk-off regime. The target asset allocation is whatever is here. So 40% Bitcoin, 30% Ethereum, and 30% Cardano. And honestly, the reason that we selected just Ethereum and Cardano is just because they have the most data. Like a lot of crypto assets are very new, so we didn't want to put in a bunch of assets that and only get a back test since like 2021. That just wouldn't be very representative. So in order to get a lot more data, we threw in Cardano, Bitcoin, and Ethereum, and then we've compared that to an asset allocation of 50% Bitcoin, 25% Ethereum, 25% Cardano. And then we've also compared it to just Bitcoin. And so you can see here, Sharpe ratio of just Bitcoin is 0.94. The Sharpe ratio of the target the benchmark portfolio is 0.98, and then our Sharpe ratio is 0.40. So we have a significantly lower volatility, significantly improved risk-adjusted returns by systematically managing our portfolio based on the market regime and based on our positioning signals. And another thing I forgot to mention. So in a risk-on regime, our target asset allocation is 40% Bitcoin, 30% Ethereum, 30% Cardano, and in a risk-off regime, we're moving that to 60% Bitcoin, 30% Ethereum, or 20% Ethereum, and 20% Cardano. So we're adjusting more Bitcoin in a risk-off regime, 60%, and more altcoins in a risk-on regime. So compound annual growth rate, we have a 76% compound annual growth rate, and because crypto, like momentum in the crypto market is much, much stronger. So, the general idea of momentum, like the traditional theory of the whole traditional theory that underlines trend following is that higher prices tend to lead to higher prices and lower prices tend to lead to lower prices. And in crypto, because it's a little bit more of an inefficient market and it's much more driven by momentum, that's even more true than in like the stock market. So this means that, in bear markets, when crypto is going down, it's going way down, and in bull markets, when it's going up, it's going way up. And so this makes trend following an even more effective strategy in the crypto market, which means by using our systems, we're significantly outperforming the market by managing our drawdowns. So you can see that we have a 76% compound annual growth rate, which obviously that's incredible crypto returns, but obviously that comes with higher risk. 50 versus a 50%, 57% for the benchmark portfolio, and then 50% for Bitcoin. And then our maximum drawdown is also like pretty much cut in half. So our maximum drawdown is only 42%, whereas the maximum drawdown for the benchmark portfolio is 78%, and the maximum drawdown for Bitcoin is 76%. So again, by systematically managing our portfolio based on what the market regime is and based on the positioning signals, we're able to dramatically decrease our risk, and also that means we're able to be sitting in cash when the market is going down, which allows us to compound returns at a much higher rate. So we're capturing the upside of the market, managing our drawdowns, and then we're getting back in the market and riding it up even higher. So significantly higher returns, significantly better risk metrics. And we're doing it consistently and predictably, and we're not doing it based on just like guessing or trying to predict what the market is going to do. And I think that's even more important in the crypto market because in the crypto market, there's so much hype. There's so much just like people FOMOing in, like people jumping out on little dips, and having a systematic process is even more important for trading crypto if you want to manage your risk. Because it just helps you just cut out all the noise. There's so much noise in the crypto market. 95% of what you see in the news, on Twitter, wherever, is all noise, and there's no signal. And so by following a systematic process, obviously combined also with our research process, that gives you context for following these signals, right? Like you not only understand what regime are we in and what are, how strong or weak is the market, but you also have context, like with our macro research and stuff, for like what macro dynamics or market dynamics are actually driving those changes. And by combining all of those factors, the systematic process with our research, we really get a good understanding of actual signal and doing based in making decisions based on observing the macro environment and observing the market. And it helps us make rational decisions instead of just trying to guess and to buy and sell and follow the fear and the greed, and basically like, which is just not an effective strategy at all. And especially if you don't have that much time. If you're somebody who doesn't have a lot of time to follow the markets, then you hop on Twitter, you see something that's bearish, and you see the Bitcoin is down 2%. You're like, oh, it's time to sell, right? And then maybe Bitcoin starts going up again. And it's just not a good way to manage risk. And it's also a great way to lose a lot of sleep. So by using a systematic process to manage our portfolio, we're able to manage risk, still capture the massive upside that's available in this market, in this asset class, and sleep better at night, and have much more liquidity when we're in bear markets.